While retail is busy arguing about Nvidia's $3 trillion valuation, Mark Zuckerberg just quietly telegraphed where the real AI fortune is being minted. 2,600 megawatts. That is the staggering amount of nuclear power Meta just locked down through Vistra to keep their AI alive. We aren't talking about chips anymore. We're talking about a physical war for the grid. Vertiv just reported a massive 83% surge in adjusted earnings because these AI servers are running so hot, they literally require industrial-grade liquid cooling just to keep from melting. Meanwhile, Eaton is dropping $9.5 billion to acquire Boyd Thermal, effectively cornering the market on AI heat management. Wall Street villains are quietly rotating out of the headline chip names and piling into the physical backbone. Dark pool data shows institutional accumulation in VST, VRT, and ETN while retail is left holding the bag on overextended software plays. They want you focused on the brain so they can own the heart and the lungs of the entire industry. Don't let them front-run you on the actual infrastructure. If you want to stop being the exit liquidity for big banks and start trading like an insider, hit that like button and subscribe. I'm here to help you fight back by exposing the moves they think you're too retail to notice. The wealth expectancy here is massive. We're looking at a potential 20 to 30% upside in these infrastructure plays as the power and cooling platform becomes the most valuable real estate in the world. Think the AI boom is over? You're looking at the wrong stocks. In the next 60 seconds, I'm revealing the exact entry points for the three stocks Wall Street is desperately trying to keep quiet. Now let's slow this down, because this is where most retail investors get trapped. They see Nvidia. They see the chart. They see the headlines. They see the CEO on stage. Then they assume the entire AI trade is one stock. That is the mistake. Nvidia is the signal. But the AI economy is much bigger than the GPU. A GPU needs a rack. A rack needs cooling. Cooling needs power. Power needs switchgear. Switchgear needs grid capacity. Grid capacity needs utilities, natural gas, nuclear, substations, transformers, and years of capital spending. That is the chain Wall Street is now studying. And that is why this setup matters. The AI trade is moving from the digital layer into the physical layer. This is not just about software margins. This is about megawatts. It is about heat. It is about land. It is about electrical capacity. It is about keeping the AI factories running. That is the big judgment. The obvious trade may already be crowded. The real opportunity may be hiding one layer deeper. And that layer is power, cooling, and grid infrastructure. Let's start with Vistra. Ticker VST. Vistra is not a traditional AI stock. It does not make chips. It does not train models. It does not sell a chatbot. That is exactly why retail can miss it. Vistra owns power generation assets. That includes nuclear power. And in the AI era, reliable power is becoming strategic real estate. Meta did not sign long-term power agreements with Vistra because utilities are exciting. Meta did it because AI data centers cannot afford unreliable electricity. Training and inference loads need constant power, not vibes, not promises. Actualilectrans. That is why 2,600 megawatts matters. It tells you the scale of the problem. This is not one office building asking for more power. This is big tech locking up enough energy capacity to support a new generation of AI infrastructure. And here is the part retail investors often miss. When a hyperscaler signs a long-term agreement that can change how the market looks at the supplier, a boring power generator can suddenly look like a strategic AI infrastructure partner. That is the repricing. That is the reason VST has become more than a utility trade. It is now part of the AI capacity trade. The next catalyst is simple. Earnings, guidance, power price commentary, contract updates, and management's tone on data center demand. If Vistra shows that AI power demand is turning into real cash flow visibility, Wall Street may keep giving an AI premium. But there is risk. VST is not risk-free. Utilities and power producers can be exposed to regulation, commodity swings, outages, political pressure, and valuation resets. If the market decides the AI power story is already priced in, the stock can pull back fast. So this is not a blind chase. This is a watchlist stock with a major catalyst window. Next is Vertiv. Ticker VRT. This is the name retail investors understand once they see the data center. Vertiv sells critical digital infrastructure, power management, thermal management, racks, cooling systems, services, The boring stuff that becomes priceless when a billion-dollar data center cannot go offline. And right now, the center of the story is heat. AI chips are not just more powerful. They are hotter. They are denser. They are changing the physics of the data center. Traditional air cooling can only take you so far. At a certain point, the racks need liquid cooling. That is where Vertiv becomes interesting. The market is not paying attention to Vertiv because it sounds sexy. The market is paying attention because the earnings are speaking. An 83% adjusted earnings surge is not a small detail. It tells you that demand is hitting the income statement. And when demand moves from story to numbers, Wall Street listens. This is why VRT may be one of the clearest second-order AI stocks. Nvidia sells the engine. Vertiv helps stop the engine from burning down the building. That is the punchline. If AI rack density keeps rising, cooling becomes a bottleneck. If cooling becomes a bottleneck, Vertiv becomes harder to ignore. The possible breakout catalyst is continued backlog conversion. Investors want to know whether this demand is durable. They want to know whether orders are still strong. They want to know whether margins can hold. They want to know whether liquid cooling becomes a permanent standard. That is the debate. And the risk is valuation. VRT has already had a major run. The stock is not some forgotten penny name hiding in the corner. A lot of smart money already found it. That means earnings quality matters. Guidance matters. Margins matter. Any sign of slowing orders can hit the multiple. But the reason VRT stays on the watch list is simple. If AI data center buildouts keep accelerating, cooling is not optional. It is survival infrastructure. Now let's move to Eaton, ticker ETN. Eaton may be the cleanest everything as a grid story. This company lives at the intersection of electrification, power management, industrial infrastructure, and now data center cooling. For years, investors treated Eaton as an industrial company, not a hype name. But in this market, that can be an advantage, because AI is forcing the physical world to upgrade. Data centers need switchgear. They need electrical distribution. They need power management. They need thermal systems. They need integrated solutions. And Eaton is trying to position itself as a full-stack supplier for that demand. That is why the Boyd Thermal acquisition matters. Eaton is not just buying revenue. It is buying a deeper position in liquid cooling and thermal management. It is trying to connect power and cooling into one data center platform. That is important because hyperscalers do not want a scavenger hunt. They do not want 10 disconnected vendors solving 10 disconnected problems. They want partners that can deliver complex infrastructure at scale. That is the opportunity. If the AI build-out becomes a decade-long electrical upgrade cycle, Eaton can become one of the adult-in-the-room winners. Not loud, not flashy, but deeply embedded. The catalyst for ETN is different from VRT. It is not just one quarter. It is integration, backlog, data center orders, margin performance, and whether investors start valuing Eaton less like a traditional industrial and more like a core AI infrastructure platform. That is the re-rating potential. But again, risk exists. The Boyd deal is large. Big acquisitions create integration risk. If Eaton overpays, underdelivers, or fails to convert demand into margins, the market can punish the stock. There's also macro risk. If rates stay high and capital spending slows, industrial names can feel pressure. But the strategic logic is powerful. Power plus cooling is becoming the new language of AI infrastructure. Eaton is moving directly into that language. Now step back. Look at the pattern. Vistra is power generation. Vertiv is data center cooling and critical infrastructure. Eaton is power management plus thermal systems. 3 different businesses. One shared trend. AI is becoming physical. That is the market anchor. Nvidia made investors rich because it supplied the brain. But the brain needs a body. That body needs electricity. It needs cooling. It needs grid capacity. It needs industrial systems that most retail investors used to ignore. This is why the next rotation may not look like the last one. The last phase of AI was about chips. The next phase may be about capacity. Who has power? Who has cooling? Who has grid equipment? Who has data center exposure? Who can solve the bottleneck? That is where Wall Street may already be repricing the second-order winners. And retail usually finds these trades late. Retail waits for the headline. Retail waits for CNBC to say the words. Retail waits until the stock is already up. Then retail asks if it is still a buy. That is not how breakouts usually start. The biggest moves usually begin before the crowd feels comfortable. That does not mean you blindly buy every AI infrastructure stock. It means you build a watch list before the narrative becomes common knowledge. For this setup, the watch list is simple. VST for power generation and nuclear-linked AI demand. VRT for thermal management and liquid cooling. ETN for electrical infrastructure and grid-to-chip solutions. These are not the same trade. That is important. VST is more tied to power markets. VRT is more tied to data center equipment demand. ETN is more tied to industrial electrification and integration. Different drivers, different risk profiles, same AI infrastructure umbrella. That is how you avoid thinking like a headline chaser. Layer 1 is the AI model. Layer 2 is the chip. Layer 3 is the server. Layer 4 is the data center. Layer 5 is cooling. Layer 6 is power. Layer 7 is the grid. Most retail investors stop at Layer 2. Wall Street is already moving deeper. Now let's talk about the entry logic. Not a promise, not financial advice, not a signal to blindly buy. Think of this as a framework. For VST, the key is whether earnings confirm the power demand story. If the stock runs into earnings, pullback risk rises. If it sells off, but management confirms strong demand, the setup may improve. Watch the prior highs. Watch volume. Watch whether buyers defend key moving averages after earnings. That is where the story becomes tradable. For VRT, the key is whether the market keeps rewarding backlog conversion. If the stock breaks higher on strong volume after earnings digestion, that can show institutional sponsorship. But if the stock fails at resistance after a huge run, be careful. A great company can still be a bad entry if everyone is already crowded into the same trade. For ETN, the setup may be slower. This is not always the fastest mover. But if the market starts treating Eaton as a data center platform instead of a traditional industrial, the re-rating can be powerful. Watch for breakouts above prior highs. Watch relative strength versus the industrial sector. Watch whether data center commentary becomes a bigger part of the story. That is the signal. Now here is the risk section. Keep it professional. This entire trade has 3 big risks. First, valuation. AI infrastructure stocks have already moved. If expectations get too high, even good earnings may not be enough. Second, capex timing. Big tech may be spending aggressively now, but if hyperscalers slow data center spending, suppliers can get hit. Third, crowding. Once everyone discovers the same hidden trade, it stops being hidden. That is when volatility rises. So do not confuse a strong theme with a guaranteed straight line. The market does not pay you for being excited. It pays you for being early, disciplined, and patient. That is why this is not just a stock story. This is a market rotation story. If AI keeps expanding, the pressure point shifts. From chips to power, from servers to cooling, from software to substations, from hype to infrastructure. And that is where the opportunity window may be open right now. The market is missing this because it still wants a simple AI story. One CEO, one chip, one earnings beat. But the real world is more complicated. The real AI economy needs physical capacity, and the companies that provide that capacity may become the next major winners of the cycle. VST, VRT, ETN, 3 tickers, 3 ways to play the hidden AI power trade. Not because they are guaranteed to go up. Nothing is guaranteed. But because they sit near the bottlenecks that could define the next stage of artificial intelligence. Power, cooling, grid, that is the framework. So here is the final takeaway. If you think the AI boom is over, you may be looking at the wrong layer. If you think Nvidia is the only trade, you may be missing the infrastructure underneath it. And if you wait until every retail investor understands the grid story, the best part of the move may already be gone. This is where Stock Breakout focuses. Not on chasing yesterday's headline, not on buying the most obvious ticker after the move, but on finding the second-order stocks that Wall Street may be repricing before retail catches up. If this watch list helped you see the AI trade differently, hit the like button now. Subscribe to Stock Breakout for the next breakout setup before it becomes obvious. And drop your strongest ticker below. VST, VRT, ETN, or another AI infrastructure name I should put on the board next. Retail usually finds these trades late. This channel is built to find them early. I'll see you in the next breakout.